Uh, Dear friends, well-wishers, and policy development enthusiasts, welcome to the webinar series of GRAAM, that is Public Key Policy. We are delighted to start this series having one of the country's expert economist and academician, Professor Bhanumurthy ji, with us. Today we would be discussing on global economic development and India's economy. Friends, I'm sure you all agree that we are extensively discussing about money and economy in the last 1 month, probably more than we usually do. There are, of course, reasons. What started with the war between Russia and Ukraine, and what turned out to be in Sri Lanka, just below our nose, further made the discussions hot. What used to be an example for a development model, now a case for studying a disaster. What we used to refer as especially in development sector, we used to refer Sri Lanka's case for a good health programs, etc. I still remember the first statement made by my professor who taught me in my graduate school in economics class. Money is the lifeblood of economy. And as we know, RBC, WBC, platelets, and plasma are the essential components of blood. Similarly, our central bank, government, commercial establishments, people, and of course, in these days, increasingly international affairs and markets are essential components of economy. We have to balance between many things. And of course, I'm sure you agree it's a complex thing, right? In order to make this complex thing simple, we have Professor Bhanumurthy with us today. Professor Bhanumurthy has taken charge as first Vice Chancellor of Dr. B.R. Ambedkar School of Economics, University, Bangalore, which is popularly known as Base University. Many of you might be knowing, but I'm delighted to read his brief bio. His research areas are macro monetary economics, fiscal policy, international money and finance, macroeconomic modeling, and developmental economics. In these areas, he has authored over 70 research papers and over 5 books. He has served on over 22 governmental committees constituted by Ministry of Finance, Ministry of Statistics, Rural Development, and list goes on. In nutshell, various ministries and policy bodies of Government of India and other state governments. Dr. Bhanumurthy has been the Secretary of the Indian Economic Society since 2006 and also Managing Trustee of Indian Economic Association Trust for Research and Development since 2010. He had a brief stint at UNESCAP, Bangkok, and at UNDP RCC at Colombo as macroeconomist. He was a visiting fellow at MSH Paris, McGill University, Montreal, and ADB, Manila. He has been a consultant to UNDESA, New York, and UNESCWA, Beirut, and UNDP, Nepal, and various other UN organizations. He has received 2 prestigious awards, that is Mahalanobis Memorial Medal, the National Award for the year 2014 for his outstanding contribution to the field of quantitative economics in India, and V.K.R.V. Rao Prize in Social Science Economics for the year 2015 for high quality research and for significant contribution to the social science research in India. I welcome you, Professor Bhanumurthy. It's our privilege to have you with amongst us in this webinar today.
Thank you so much. Thank you so much, Dr. Basavaraju. First of all, let me thank GRAAM for inviting me to this new initiative, I guess, public key policy discussions.
Yes.
I'm also glad that this session is chaired by Dr. Vijaya Deepti. As Dr. Basavaraju pointed out, there are a lot of discussion about, what's happening in outside the world, outside the country, and what's happening inside the country in terms of economics. And especially this issue got heated up when the rupee hit 80 rupees per dollar. I think that has become a headline grabbing kind of a issue, and it also got into some kind of political discussions. So keeping that politics aside and what I try to do in the next 20-25 minutes, with the permission of chair, that I would like to bring in some of the issues, what's happening in India right now, and what's happening in the global world, and to what extent the India would be affected by the developments in the global economy. And at the end, I would like to explain where the Indian economy is going forward, and will it have too much of disturbance that we had in the last 2 years due to COVID-19 and all those things. First of all, shocks have become for Indian economy, shocks have become very, very regular right now. We have seen in 2008 crisis, and we have also seen 2012 Eurozone crisis. Then we have seen COVID-19, and now we are experiencing what is called post-COVID crisis across the world. So in that context, I would like to explain to all of you that India is really well placed to mitigate the kind of risks that is actually generating in the global economy. To bring it little more basics and to bring in some more recent trends in the Indian economy, I'm sure many of you know that post-COVID growth rate of 8.4% in 21-22 is one of the highest among large economies in the world, and more than that, for the year 22-23, there are a lot of predictions are there that India would achieve at least 7% growth in the current year. In fact, RBI predicts 7.4%, and even the international agencies like IMF, World Bank also predict somewhere close to 7%. So the reason why I'm trying to say the 7%, I think it's very important for all of us to understand that the 7% is on the back of so many risks that is been happening, emanating from the global economy, especially the advanced economies where India is dependent very heavily on. So the 7% is something certainly is an important number for all of us to really remember. But at the same time, we have also seen the inflation. I think this is something which affects all, right? Whether it's a rich or poor, compared to GDP, in my view, inflation is the one which actually affects each and every household. We know that GDP may not be distributed properly, but we know the inflation actually distributes much more equally and much more faster, right? I think that is the reason why inflation becomes a very, very important, socio-economic or political variable. So as and when the inflation really hits the tolerable level of inflation, what we call, is if it goes more than that, I think it will create its own repercussions on the ground. So we have seen the inflation going up to 7.8% also in the month of April, and right now it is less than just close to 7%. And I think there are projections that inflation is appear to be very sticky for some time, and we need to do many more things to really bring down the inflation below the 6%, or what the RBI says median inflation target of 4%. So in fact, the RBI governor very clearly mentioned that we may be staying with inflation for some more time than we really like to. So that is something that is really, but in any case, we need to really understand what drives this inflation, right? I think that's more important for public policy. But more than what drives inflation, I think what's important is what is the current situation when it comes to inflation expectation. I think generally in the media and many places, we really don't talk about inflation expectations. But it's very important for a simple reason that the public policy response would be more on inflation expectation than on the inflation which is already happened and you cannot really address the inflation, but rather you can address the inflation expectation. So I think what I'm trying to say that inflation expectation means inflation forecast for the next 6 months or 9 months down the line, and the RBI says that inflation is going to be above the 6% for next 6 months. So for that reason, what RBI has done, in fact, they brought in the monetary tightening policies, and we have already seen how RBI tightened 3 times, and we have already reached 5.4%, the pre-COVID kind of a situation. In a sense, the kind of policy support that was being given during the COVID-19 actually been reversed, right? I think that's something that we need to remember. So, by the way, when you look at the COVID response in the month of March 2020, it was the RBI which came ahead much before the fiscal policies, where they provided kind of a support for the overall market and brought down the interest rates to somewhere close to 4%. So right now we have gone back to the pre-COVID kind of situation, and we need to understand whether it will have its impact on GDP growth or not. And we have also seen that a lot of reports happening. I mean, a lot of reports have been coming up where there seems to be a risk building up in the external account. When you say external account, we have both capital account, there is a current account, and capital account is slightly easy to manage, but current account is something which we need to keep in mind, that you need to look at this particular segment a day-by-day basis, because you need to service the current account. So right now there are estimates that says the current account deficit, which is an important variable when we talk about external account, actually somewhere close to 3%. In fact, some estimates says we actually breached 3%, and we need to understand that when I say 3%, a lot of studies have said that the tolerable level of current account deficits for India would be somewhere close to 2%. So in a sense, we are much higher. We are running a current account deficit of much more than the tolerable level of 2%. On the other hand, we have seen the foreign exchange reserves depleting since I think from September 2021. We have seen somewhere close to $60 billion going out for various reasons. Again, we need to understand that $60 billion going out is not necessarily because of foreign capital flow going out, but more importantly, there is a widening of trade deficit, and I think that seems to be leading to dwindling of foreign exchange reserves. And there are many people believe that even now, the current level of foreign exchange reserves that India has, I think we can easily manage for one more year. So in that sense, there are some kind of comfort when it comes to the external account. In terms of the fiscal policy or fiscal position, again, I'm sure all of you must be reading day in and day out. Even yesterday, Niti Aayog meeting also, we have seen how the state governments are actually expressing their inability to do any kind of fiscal expansion, because the fiscal situation is actually in a very poor position. Why I'm telling all these things are because everything is interrelated. Okay, so when you talk about current account deficit or exchange rate, foreign exchange reserve, GDP growth, I think everything is interrelated. So I think it's important for us to understand in a somewhere holistic manner. I have already talked about current account deficit, and one of the reasons why we are seeing a widening of current account deficit is because exports are actually declining while the imports are actually increasing. Again, for a reason, as Dr. Basavaraju pointed out, that all this happening because of some kind of a unfriendly kind of a economic trends that is building up in the advanced countries. Exports, when we say exports are declining, I would like to tell the audience here, exports is actually a simple function of external demand. Okay, so the external, I mean, if the GDP in the global growth is happening, then you also see that exports also will keep increasing. So, and irrespective of what is the exchange rate, I think it's very important again to understand that exchange rate matters very less when it comes to exports. And I think exports is just a function of external demand. And imports, we have again seen what happened in the import side, and we have seen why one of the reasons why imports have gone up is because of the rise in the international oil prices. But again, one needs to really these are all empirical issues. What I'm trying to share is that it's purely based on my own research. Again, imports, if you say imports, total imports will have a completely different behavior. But if you talk about oil imports, we have a different behavior. And if you talk about non-oil, again, you have completely different behavior. So what we are seeing right now is the increase in the oil imports, which has actually led to widening of the trade deficit, and that seems to be putting more pressure on current account deficits as well. And one of the things which I keep telling, I don't know how many of you read some of my writings. One of the things why I find this time it is different for India. When I said, India is facing shocks on a regular basis, but this time around we are seeing a slightly different outcomes of those shocks, purely because of one major factor, and that is, in fact, that has not been really appreciated much in the general discussion and the media, is that we had a very perfect coordination between the fiscal and monetary policies. You have never seen this kind of a coordination, and where even at the cost of assuming that what to say, active monetary policy or a passive fiscal policy, there's so much write up on that. But despite that, what we have seen is a very coordinating policy responses, both from the fiscal and monetary policy, and that actually really gelled well, and that actually helped India to really overcome even a kind of a crisis that once in a century kind of a crisis, COVID-19. We have managed extremely well when it comes to macroeconomy, and that is largely due to a perfect coordination between the fiscal and monetary policies. So this is about the domestic policies, and let me come to what is happening in global environment, and at the end I will try to link it these two components. So I think that's what is important right now. So we all know that the United States actually got into what is called technical recession. I mean, when you say technical recession, that is negative GDP growth for 2 consecutive quarters, and that actually happened in the United States. And there is again there are predictions. In fact, the Bank of England very clearly mentioned that the UK is actually getting into the recessionary phase, and even the Eurozone also getting into the crisis. And all these three, groups like UK, US, and Eurozone, which are supposed to be called as advanced countries, all of them are actually experiencing close to double-digit inflation. I think that is the kind of a crisis that they have. And if you want to understand the extent of the inflation, the double-digit inflation is against the threshold level of inflation of 1.5 to 2%. For India, it is up to 6% we can go. That is 2 to 6% is the inflation. But when it comes to advanced countries, it is 1.5 to 2%. Against that, they were somewhere close to 10% inflation. And this is an outcome of kind of a irrational fiscal stimulus that have been provided, which led to large money supply in the world, and actually that led to the double-digit inflation. In fact, we had this kind of a situation post 2008. In fact, 2008 crisis was never a crisis for India, but actually the post 2008 fiscal policies have actually led to a crisis. And I'm sure all of you know that India had to experience a double-digit inflation for 2 consecutive years. In fact, we had 14% inflation for almost a year. I mean, against what we are seeing right now, somewhere close to 7%. So this time around, again, I want to reiterate this point, that this time around, we had a much better fiscal and monetary policies, which is not actually inflationary. Okay, and I'll come to that little later. And following this high inflation inflationary conditions in the world. We have seen the interest rates of advanced countries are actually firming up, and some are actually pointing out that United States are actually experiencing inflation of what they experienced in early 1980s. Okay, 1980s. If somebody wants to understand, I think they need to understand the U.S. crisis in 1980, where they had something like 20% inflation. Okay, and in fact, at that point of time, the Federal Reserve has actually increased the interest rate by 12 percentage points. We are talking about 0.5, 50 basis point, 25 basis points. But the United States actually increased the interest rate by 12 percentage points, what we call it as Volcker effect. Okay, Paul Volcker was the Federal Reserve Chairman, and he had to hike the interest rate by 12 percentage points to really bring down the inflation. So now the United States actually facing a similar situation, may not be in terms of the magnitude, but in terms of the inflationary pressure. And again, as Dr. Basavaraju pointed out about the geopolitical issues, we have seen Ukraine-Russia war, and we have seen, so almost, I think there's a risk building up on the, Taiwan island. So, so all those things are happening, and we also see that there are a lot of supply side bottlenecks which have been which have generated during the COVID-19 are still not really overcome. So given all these things, there is certainly there is a supply side constraints in the world to really revive the economy in a strong way, that so that we can go back to the pre-COVID kind of situation. On the other hand, what we have is we have a the extraordinary kind of a fiscal stimulus measures which led to large money supply in the world. And I'm sure all of you understand, when there is a large increase in the demand while there is no response on the supply, we all know that what happens. Basically, it has led to the large inflationary pressure. But when it comes to India, there are many people, there are two types of argument that we have. Some group thinks that, Indian government, but both center and states, have not really provided enough fiscal stimulus, right? I think that is an argument that many economists will say. But if you look at the numbers, when you look at the fiscal deficit of both center and states, for the third consecutive year, we are running a double-digit fiscal deficit against the target of 6% for the whole country. So anybody who says, in fact, I keep saying that we had the fiscal stimulus of more than 30% of GDP for 3 years. So I think that needs to be really highlighted. When we talk about stimulus, we always say that central government, right? So I think it is important to really talk about the general government fiscal deficit, and the stimulus was somewhere close to, in fact, more than 30%. That I think that needs to be kept in mind. But why we are not seeing the kind of inflationary pressure that the advanced countries are seeing, I think that is exactly where we did slightly different from the advanced countries. So with the 30% fiscal stimulus that I'm talking about, in fact, it is largely towards capital expenditure. And I'm sure, again, you must be reading when you talk about fiscal policy. I think even today also there are some news items that said that, the central government is willing to release more resources for increasing the capital expenditure or public investment. So I think this time around we have done slightly different, because we have done much more to create capacity in the economy rather than just create demand, which is a simple Keynesian, what we say, Keynesian philosophy, that you increase the fiscal stimulus so that you create demand. But I think what we have done this time is you increase the fiscal stimulus to create capacity, to create supply, so that it will not lead to inflationary pressure. So I think that's one reason why India has actually done extremely well. So when it comes to oil prices, and let me spend a few minutes on the impact of the external sector developments on the domestic economy. One is about the Ukraine-Russia war. I think that's something many of us thought that it has really created the risk on the external account. But my position is slightly different. In fact, within 2 days of the Ukraine-Russia war, there was some discussion, and then I said, because of Ukraine-Russia war, we are not going to see a rural distress. Okay, and it says blessing in disguise for the rural economy. And if not for Russia war, I mean the Ukraine war, we would have seen a crash of food prices in the economy, because this year we have seen a bumper production of food grains. You talk about wheat, you talk about rice, and this year has been a fantastic period. You know, if not for the Ukraine war, we would have seen the wheat prices collapsing. And I think the Ukraine war actually helped the rural economy. And I mean, somebody wants, I can really, I mean, if there's any question on that, I can always explain why I think that Ukraine war has actually helped Indian economy, especially the agriculture sector. And that is something seems to have really helped the rural economy overcoming the kind of distress that they had for the last 2 years. And in terms of the oil prices also, we went to the extent, I mean, again, there are a lot of nitty-gritties which we don't really understand, but you know, not that I also understand, but at least I try to analyze. When it comes to the oil prices, again, it has actually helped the Indian economy. Many people may be surprised to know this, because you know we have again, Indian government has actually managed this crisis. In fact, the relationship between India Russia, you know, has been, that friendship has been leveraged between the companies. And in fact, European Union and many other people have actually objected to what India was doing, because India was getting the oil, crude oil, at 30% discount. That is the minimum discount you know, any oil companies were actually getting. Now, you know, we went to other side of this thing. You know, we started putting tax on the export of oil. You know, so we were becoming very competitive in the international world because we were getting cheaper you know, import of crude oil. And as it is, India has been has been a leader in refined crude oil or refined oil, whatever it is. And many of you may not know that in our export basket, 25% is actually the oil exports. How can you expect a country like India, which is a net oil importer, exporting 25% of your exports as, you know, oil? So I think this premium of 30% that they were getting from the Russian companies actually cushioned, you know, the kind of impact it would have had on India. So there were a lot of countries, they were envying that, you know, India and Russian relationship seems to be helping India to overcome so that you know, the oil price shock. So in that sense, again, the transmission of the international oil prices, which many times when we say international oil prices, we only look at the Brent oil, crude Brent, which has gone to 115 or 120, actually was not a reference price for domestic oil, because we started increasingly importing from Russia, and I think that actually helped very much to contain the imported inflation. On the other hand, there are many other commodities, the prices in the international market has actually gone up, and that has created some kind of imported inflation. But even that seems to have been very short-lived. Now, if you look at the recent trends in the food prices, actually come down. It's much lower than pre-Ukraine-Russia war. So that seems to have actually, we seems to have managed better even the food, commodity prices. It's only the exchange rate. I mean, exchange rate is something when the exchange rate is actually depreciated to 80 rupees per dollar. Many people felt that it will have a dampening impact on the external account. But in my view, again, there was some write-up on this. In my view, I think exchange rate is basically a shock absorber, rather, so it's more of an automatic stabilizer, so that, whenever there is a pressure on the external account, by changes in the exchange rate will actually help in mitigating the kind of risk that was actually transmitting to the Indian economy. And again, it is very short-lived, right? Right now it has come back to 79.6 rupees or something like that per dollar. But overall, the point I'm trying to say is that the impact of the international oil prices and its transmission to Indian economy had been very limited. But the biggest problem happened on the external account, particularly on the capital account, where there was an outflow. In fact, that outflow is also not entirely because of trade deficit, but also because of central bank intervention in the forex market. So I would like to take a position that the central bank intervention in the forex market to reduce the volatility of exchange rates have been going to be having much more positive impact on the Indian economy than the loss of the foreign exchange reserves itself. So in that sense, I think RBI has managed the external account again very well. By the way, when the foreign exchange reserve depletes, it will also reduce the money supply in the economy, and that will actually reduce the inflationary pressure in the economy as well. So I think that whole mechanism of exchange rate, foreign exchange reserves, inflation, in my view, I think RBI seems to have managed extremely well. This is not the first time RBI has managed. They have been managing this kind of situation for a very, very long time, and they continue to do. And in a way, I would like to end by saying that we are actually in a safe hand of RBI, and this time, of course, fiscal policy as well. But there are risks that are actually building up at the state level. I think that's a completely different subject. So in that sense, I must say that inflationary pressure is coming down. We started looking at recovery of the Indian economy in a better position compared to other countries. Of course, there are some risks that is coming up on the external account, but thank God we have RBI in this country. So let me stop here.
Thank you so much, Professor Bhanumurthy. That was very insightful. It was very crisp, very clear, and very candid. Thank you so much for the thought. Now I go to any audience or participants. If you have any question, you can post them in the Q&A corner as well as in the chat box, or if you can also raise your hand. My colleagues will unmute you, help you to unmute, and probably ask you a question directly. But I prefer you to write the questions in the Q&A box using the Q&A box. While audience are given with some time to frame their question and ask their question to you. I have a couple of discussions point with you. Like, of course, you clarified it actually. The falling rupee value against dollar is not something we should be worried much actually. But having said that, we also kind of in the Ukraine-Russia war, we also witnessed Russia demanding the trade in the Russian currency, and of course now this discussion has come into the forefront. The trading in the exporting countries' currency. What is your opinion on it? How it is feasible and how it is should be pushed by a developing country like us?
So actually, it's a very important question. The rupee trade was already in discussion for a long time. In fact, that has been the long-term goal of this country, where we would like to see the rupee also one of the reserve currency. Okay, but we already had some kind of trade in rupee between India and Iran, and there were some objections to that. Now, recently, RBI came out with a very important notification saying that India would allow the rupee trade, and actually, it's more of a policy. It's like what you can say. It's an exposed kind of a policy, And in my view, irrespective of whether the RBI is allowed or not, many Indian oil companies were actually dealing with Russian oil companies in the domestic currencies. Okay, and that was happening, and I think RBI's notification only legalized those kind of in that sense. So I don't want to take up the companies' names, but they already had that businesses happening between Russian companies and Indian companies. So the policy, the RBI policy, only supports that kind of a trade, and that is another reason why I said the exchange rate going to 80 or little more than 80 was never an issue when it came to the oil prices or the domestic oil prices. Even that, so by allowing the rupee trade, the one of the transmission channels of the exchange rate channel in the oil prices has been really nullified. So you start dealing with rupees, and then you also settle with. In fact, we have a much better trade between India and Russia. It also helped exporting. Some level of trade was happening somewhere, almost like a barter kind of a system, right? And there whatever the net exports or net imports, so that was in rupees. I'm sure that will be settled down because of the RBI notification.
Okay. Thank you so much for clarifying those things actually. And there's a question from Amulya Bharadwaj, one of our participants today. She says, and I read that it is being showed that India will be facing a great recession, startups being closed sooner. This has led to an increased migration to countries like UK, Canada, etc. How do you see this?
No, each and every point that is raised needs some empirical verification. Okay, I don't think it's also part of that. You would have heard something like K-shaped recovery, right? Now, in my view, K-shaped recovery is a constant process. Every year, even in the high growth period, you would have seen some units closed, some units getting constant, stagnating, some units, new units may be coming up. So I think the startups being closed, again, I'm not really sure whether the data supports that kind of a hypothesis. There are some startups actually flourishing very well, right? We have been claiming ourselves that the largest unicorns in the world is happening in India, and most of them are happening in Karnataka, right? So I would not really like to support this argument that startups are getting closed. There may be some churning seems to be happening in that, but overall, I think we are doing very well. But in terms of great recession, I don't know. It's 100 years old kind of a concept. I'm not really sure whether India is anywhere near recession. And in fact, I'm sure the person who asked the question, he or she must be reading this stagflationary conditions. I'm not sure anywhere India is near to that kind of a situation. We are, again, I keep saying again and again that we are much better placed than what we were during the post-global financial crisis. And again, I attribute this to the macro policy coordination.
So thank you so much, actually. And of course, there's a question from Mr. Pradeep, and it says it is predicted by many that there is going to be an economic slowdown in the near future. How prepared is India to face this challenge? Of course, if at all you agree that there's going to be a slowdown, it's difficult to predict any economic things. But anyways, if at all there's a slowdown, how are we prepared for it actually?
Yeah, I think this is a reasonable question. There is a slowdown. In fact, when I started by saying that last year we had 8.4%, now we are coming to 7.4% or maybe close to 7%. So certainly that number says there is a slowdown. But is that really, is it going to be a structural slowdown? That's very important. Whether it's a one-off kind of an event, but in my view, see that 7% that's also happening because if you look at the GDP estimation, there is something like C plus I plus G plus X minus M. Now, at least 20% of our growth comes from the X component, that exports component. So as I explained, that exports are going to take a hit because of decline in the global demand. Apart from that, you see the other engines. Again, you keep hearing that India has 4 engines now. Out of that, only 2 are functioning like that. So if you look at that, out of the 4 engines, only the exports which are going to take a hit. But otherwise, the rest of the 3 engines, the domestic consumption or the investment or the government sector, are actually doing extremely well. So you should be able to see that in the absence of the demand from external world, we should be seeing a very decent growth of 7%. And again, we will be quite far away from other countries when it comes to GDP growth, when the whole advanced countries are actually facing a kind of a recession. So in that sense, well, there are other issues. This kind of slowdown that we are talking about, it might have its impact on employment and other things, but I'm sure we do have our own policy levers to address such kind of adverse outcomes due to slowdown in the GDP growth.
Thank you. And a question from Mr. Prasad. He says, Professor Bhanumurthy, you said that India should not be worried about rupee falling against the dollar. But what happens to the loan repayment of India? We would be forced to pay more interest and payment. What is your take on that?
Yeah, so again, in what the question is asking is about the external commercial borrowings by the private sector. Now, so the people who trade, who do business like this by borrowing from the external environment, we expect that they would have actually had some kind of hedging, right? Now, if they don't have hedging, I mean, that information is not available, whether they got into hedging or not. If they don't have hedging, yes, there is going to be some impact on the foreign exchange reserves. And I mean, as I said, we might face some kind of a decline in the foreign exchange reserves. But that again, that is going to be a short-term phenomena in my view. And I'm sure if you read newspapers every day, you will see that again, a lot of foreign investments are actually coming back to India in the past 2 weeks. When you talk about Indian economy, 1 week is really a very long, because so many things happens in a week. And last week had been a very, very positive week for India. Again, we started getting back that foreign exchange reserve that we lost due to intervention in the forex market. So we should be in a better position. I mean, even if there is, of course, there may be some kind of rollover that can happen. I don't think any businesses would like to pay so much interest rate, right? And I'm sure there will be a business model. So I think both RBI and the private sector would manage it better.
Yeah, I appreciate that answer. Thank you. Okay. You said about wonderful coordination between a fiscal and monitoring policy, which I actually demonstrated in this during this crisis or discussion, whatever we call. And as you said, retail inflation is around 7%. It has been between 6 to 7% consistently in the last 6 months, I guess. And RBI also raised repo rate twice by 40 and 50 basis points respectively. And the existing repo rates is, I think, around 4.9 to 5%. I could be like the number could be around that. And in the pre-COVID, it was around 5.1%. Should RBI further rise the repo rate to ease the inflation? And normally, how these decisions are taken when it comes to increasing or decreasing repo rates?
Well, I think RBI has increased the interest rate thrice, not twice. We have seen 140 basis points right now. We are right now at 5.4. And we do have a monetary policy committee. It's not the RBI that does anymore. There are 6 wise men who are sitting, and 5 wise men and 1 woman sitting in the monetary policy, and who makes the decision about the interest rates. And as I just said in my interventions, that RBI or the Monetary Policy Committee look at the inflation expectations. So it is not the current inflation, it is the 6 months down the line. What is the inflation that, according to them, what would be the inflation 6 months down the line, and they would like to respond accordingly. So right now they have so many surveys like household expectation survey. There are many surveys the RBI does, and based on that, they believe that in fact the household expectation surveys results that have come up today showed that the inflation expectation is expected to be coming down. The households don't expect the inflation to go up anymore. So I think that itself is an important information for the Monetary Policy Committee. And of course, the markets already discounted that there will be one more round of hike. It might go to up to 6%. The repo might go up to 6%. That is the expectation right now in the market. And what was the question? I forgot. What was the supplementary question on that?
No. I said about like normally these repo rates actually.
Yeah,
How far
yeah.
the RBI is going to should be increasing or decreasing it further.
Yeah. So basically, RBI repo rate, in fact, monetary tightening, either they can do by hiking the interest rate or reducing the money supply, right?
Yeah.
So either way they can do that. Now this time around, not many people agree with me, but whatever the large part of the repo rate hike actually happened more due to the open economy macro issues, and not necessarily due to entirely because of the inflationary pressure. Because RBI kept on saying that inflation is expected to be much benign compared to the advanced countries, and in the month of February they didn't really predict the inflation because we have so many, it's almost tied with the politics, right?
Yeah.
So in fact that delayed increase in the domestic oil prices from November to April or so, because we had 3 or 4 state elections, seems to have really spoiled the RBI's calculation when it comes to the inflation prediction. Now, suddenly after UP election results are over, we have seen government increasing the domestic oil prices in a very substantial manner. So that actually led to a weakening of RBI's monetary policy stance. And now I think they know that there is no further hikes that can happen because of the international oil price also coming down. So I think the point I'm trying to say is that it's a difficult task, for anybody to predict inflation 6 months down the line is an extremely difficult task. And all the time, Monetary Policy Committee makes the decision based on the kind of information that is available in their own domain and their own perception about how those information is going to play out coming next 6 months. So based on that, you need to really make decisions.
Yeah. Thank you so much. It was a wonderful knowing many things from your side today. I'm sure if we have any further questions, our audience will reach out either directly to you or through us. We'll pose those questions to you. In the meanwhile, I would like to now bring in the chair of the today's talk, our trustee, Mrs. Deepti Vijaya, to tell a few words about Mrs. Deepti. She is a member of Board of Directors of Tata AIG General Insurance Company Limited. She is the chairperson of the Risk Management Committee and member Audit Committee of Tata AIG. She was the CEO of Tata Insights and Quants, a division of the Tata Industries Limited. The organization is focused on working with the Tata Group of companies on leveraging advanced analytics to address business challenges. She was with Tata Consultancy Services for over 3 decades and played several roles both at the corporate level and business unit levels. As part of the corporate governance team, she supported SBUs in their strategic initiatives and programs. In December 2009, she was conferred with the leading business women of the year award by Women Leaders in India in recognition for her contribution towards growing the insurance business within TCS despite the global economic downturn. So, Deepti, we are fortunate to have her on the board of GRAAM also, advising us in various initiatives of GRAAM. I welcome Deepti Vijaya to deliver the presidential and concluding remarks.
So thank you, Dr. Basavaraju, and it's an honor to be a part of this session. I would like to thank Professor Bhanumurthy for his excellent and very simple way of narrating on what is happening in the global economic scenarios and the impact of that, on Indian economy specifically, and what we are seeing happening in the advanced economies. So, like you mentioned, one of the things that really was very nice to see for all of us was the close coordination between RBI and the finance ministry. So like you said, the monetary and the fiscal policies were very well coordinated right through the COVID times. And I think that has helped us in addressing a lot of the challenges, which I think the economies felt that we wouldn't be able to deal with free vaccinations, we wouldn't be able to deal with the unprecedented infrastructure investments, or become the $5 trillion economy, if not more. Actually, I think all of us are looking forward to really the growth of the country. And like you said, the 7.4% is phenomenal. For even not just a country, but for any company. And like Mr. Chandrasekharan, you would say, we just wish that we would grow at that rate, at Tata Consultancy. So that's the aspirational goal that all of us would have when we talk of growth rates. And for a country of our size and our magnitude and the complexity, for us to continue to grow at 7.4% is very, very laud-worthy, and I think it's something which all of us should be proud of. Notwithstanding all that, we will continue to see inflation. Inflation has been our challenge, I think, over the last few decades, actually. So when I would talk to my global customers, they could never understand, when we talk of 6% inflation, for them, like you mentioned, 1.5% inflation was itself a big deal. And, growth rates of 7-8% was again totally unimaginable. So I think these are some of the very different and distinct things that we see in Indian economy versus many of the advanced economies. And I think, like you mentioned, the Ukraine-Russia war, we dealt with it very interestingly. And it was also interesting to see how now companies are trying to, or countries are trying to build up a parallel infrastructure to swift settlement systems and all that. I think that will be something which, having dealt with the financial sector, it will be interesting to see what comes up and how it comes up, actually. So the parallel infrastructure to SWIFT will be a very new development, and it is expected to take about another year or so. So I'm looking forward to seeing something very different, in the way settlements happen globally. But as important, I felt was, what you spoke about in terms of risk and the risk mitigations. And it's not just going to be the rupee conversions that we're talking about, rupee dollar conversion rates, but also how we deal with the overall, I think, fiscal tightening, actually, that we will have to deal with from a country perspective. We've done a lot of easing in the past, but yes, the repo rates going up has helped in tightening up the economy a little bit. And we don't know whether what will be the knock-on effect on industries such as realty. That was the other thing that was always worrying, actually. So because that's again one of the big growth sectors for India in the last few quarters, actually. I don't even want to say a year, actually. So realty has been growing very well, but this may have an impact, and a negative or otherwise. So we'll wait to see what happens there. But again, thank you for your very simple, very straightforward. I would love to know what is your take on what's happening at Sri Lanka, actually, and what do you think will happen there in terms of, I mean.
Probably we'll have to do another a webinar for it, actually, to discuss about Sri Lanka.
But it's a very interesting one. And like you said, I was quite amazed when I saw the type of development that Sri Lanka went through. and the type of infrastructure that they had built up. But then I think it all comes at a cost, actually. So, but I would love to see a webinar on that specifically. And it's fortunately, I think we don't have that much of a shock to our economy from these small ones. But yeah, it'll be interesting to see where all this is heading. But again, thank you for your time, and I really enjoyed the session, and looking forward to more of these from the GRAAM.
Yeah, please, Professor.
Yeah, just as Madam pointed out, one thing I missed out, which is my favorite topic actually, is related to Sri Lanka. I think even in India, we need to be very, very careful about our macro fiscal policies. Most of the time, the discussion is on GDP, fiscal deficit, and inflation. One variable which we completely ignore in overall public policy discourse is the public debt. I think the private sector deals with that in very differently, but when it comes to government, public debt is one thing which nobody knows actually what is this public debt, and whether the number that is being generated is that the real numbers. And in fact, I keep arguing that one number which every citizen in this country should know is the public debt to GDP ratio, leave alone GDP growth. Now, when we talk about public debt, I think it's a slightly long-term concept. As all of you pointed out, and Sri Lanka was very comfortable even in January, February, March. And then suddenly it, we got into the crisis because they never thought about what is the public debt of the country, and and I don't think India should get into that. But my problem is that many states actually ignore that whole public debt to GDP ratio concept. And I don't want to say that there are many Sri Lankas in this country, but I do see that there are a lot of potential for some of the states to blow out because the neglect of public debt concept. So finance commissions talk about it, but certainly it is not part of any kind of a public policy discourse in this country. So that's my that's been my concern for a long time. We're doing extremely well in all those things. On the flow, we are doing very well. But when it comes to the stock, it looks like somewhere the risk is building up, and we need to be very careful when we deal with these long-term goals like public debt to GDP ratio.
Yeah, there's going to be a lesson, I think, for, as you said, many Sri Lankas in India, and Finance Commission is also recently, I read one of your actually statement in that also, about that also, how we need to be very careful about handling our public debt as well as public finance. I'm sure you would learn from those, the episodes, whatever transacted around us. Yeah, thank you so much. As I said, it's going to be another webinar if we start discussing about Sri Lankan other economy. But it was very insightful and enriching discussions today. I must say that, Professor. Thank you so much for taking time for this webinar. Look forward to learn more and more from you. Thank you so much.
Thank you so much, and I welcome all of you to my university. It's a new university, and it's on the way from Mysore to Bangalore, so you can always have a stopover and.
Yeah. Because there are many Bangaloreans and other places also. Other places also.
Yeah. Please do visit us. Yeah.
Thank you so
Thank you very much. Yeah.
And thanks to all the audience and participants for taking time to join today, and wish you a very good evening. Thank you.
Thank you. Bye-bye.
Thank you. Bye.